Hello and welcome. Today we're going to be talking about a very interesting company which IPO'd in 2024 and currently sits at its all-time low in terms of price. In fact, from the IPO price to now, we've seen a 10 plus or a 15% correction, even if you were an owner at the point of IPO. So we're sitting at, in terms of an all-time low on the stock price with regard to an Awfis Space Solutions. And why is this looking interesting? Because valuations are currently at 18 times 1 year forward, and it's at the lowest point, obviously, because price is at its lowest point. And we've seen a 2 year where really nothing has happened on the stock price. And we've got some very interesting investors sitting inside, like an HDFC mutual fund. And therefore, this one looks extremely interesting. Let's try and understand what the headwinds could well be with regard to an office space. First one is the seat addition. They are guided for a 32,000, they are guided for 40,000 seats to be added this year. They've cut the guidance to 32,000 and maybe it'll be in the 30 to 32,000 band. There are reasons for that, but I'd want to understand those reasons in better perspective, and maybe coming from the management is always better. So that's the first piece. The second one is with regard to the capex itself. So while the seat guidance has changed dramatically by 20%, the capex guidance remains around 200 crore, which was the earlier capex guidance as well. So I'd want to know what else they're doing. And because they're opting to retain the premium, or rather they're opting to accelerate on the premium side, which is why the capex guidance is unchanged. What does that do in terms of an impact for both rentals, top line, occupancy and the like? Because you'd likely see better occupancy, right, if this were to happen. Now, let me also, third piece, try and understand occupancy trends better. I'd want to know, so they've said that the 9 to 12 months maturity, any seats with a 9 to 12 month maturity has an occupancy of around 80%. So occupancy goes up as the period of time goes up and the maturity of a particular center goes up. Now, I'd want to know what the occupancy trends below that 9 month kind of tenure are. May not be the most relevant, but it's interesting to understand because the kind of seat addition that's happened, you will likely see that play out over the next 9 months, which is what I'd want to understand better, which will give us a perspective also as to how it's playing out in terms of the numbers going forward. Mismatch in rental payout, which is lock-in versus customer lock-in. Now, I'll just quickly explain this point. One is the one model which they operate is the straight lease model, where they pay the lease to the owner of the commercial real estate. When they're doing that on a straight lease format, which is monthly rental to the owner, there will obviously be a lock-in period, which the owner would have put in place into the agreement. What's the lock-in period there versus the customer lock-in period? Because if customers suddenly stop adopting Office as their service provider, then that would mean that these rentals will continue to be borne by Office, which could be problematic. So I'm sure that there are clauses within that agreement, but this could be one of those risks which I could think of, that there is a mismatch in that. And we'll try and understand that better as to how it works. Office Transform is one of their businesses. I'll explain the business, but execution has not played out the way it ought to have over the last 6 months or so because of pollution regulations in Delhi. Do we expect that at least over the next 6 months, this will very, very quickly reverse? And will all of the execution happen in parallel, or will there be revenue lost is what I'd want to know. The last piece is with regard to GCC. There's very, very strong traction where GCC is concerned, and therefore GCC traction being strong. What are the margins? Margins are better in GCC or worse? We'll try and understand that piece as well. So all of this, but first off, let's try and understand what the company does and the product lines, as we always do. It's the largest flexible workspace solutions provider by number of centers in India at this point. What it does, well, flexible workspaces, managed offices, design and build services is what they do. Basically anything regarding the office which requires support, they take care of it. It caters to commercial office, real estate and flexible workspaces as well. So you as an individual business owner can actually walk into one of these office spaces and utilize them. Even that is what they cater to. And then one of their large recent clients, the National Stock Exchange, via the National Stock Exchange, they won an order, which is that they are leasing out an office space for the NSE. They built it out. They did the interiors for it. So various ways in which they are kind of evolving their business model, and we'll try and understand that better. But broadly, that is the way in which the business works. Now let's talk about the products and services, and this will give us a better perspective. One is co-working spaces, which is shared offices for freelancers, startups, and small teams. The second is managed offices, which is custom built to suit offices for enterprises and GCCs like the NSE, which I spoke about. Then there is Office Transform. We spoke about this, there being a drag in Delhi. Commercial interior fit-out projects is what Office Transform does, which is design and build. Technology, which is, it provides network, IT, security, managed services within the office itself. Office Cafe, which is, it runs its pantry operations for the office. Mobility, which is employee transportation. On-demand meeting rooms, day passes, virtual offices from different locations is also what it does to existing customers and clients, which is over 3,000 clients and customers that it has. Events and concierge services is the other piece that they do, and furniture solutions also is what they do. Current presence, and this becomes important, they are present in 18 cities, 9 Tier 1, 9 in Tier 2, but a predominant part, 90% of their centers is in Tier 1 cities, approximately 153,000. Tier 2 has around 13,000 seats at least at this point. When you're looking at West, there's a tilt towards West and South. 72% of their seats are tilted towards West and South. Centers are tilted towards West and South, I beg your pardon. Seats too, to a large extent, 127,000 seats are tilted towards West and South. And then there's North and East, where the presence is smaller, at least at this point. The business model is a straight line business model versus a managed aggregation business model. Managed aggregation is where they partner with the commercial real estate owner, and the rental is not taken, but a portion of the top line is taken by the commercial real estate owner, and the balance accrues straight to Awfis Space Solutions. The straight line is, of course, they take the space on rent and they let it out to customers. That's broadly everything about Awfis. Now let me try and explain the metrics and try and take you through the numbers that Awfis has clocked over the last 3 years. If you look at the last year compounding in terms of top line, it's been very, very solid. 68% compounding on top line. EBITDA is compounded at 82%. It was not profitable in FY22, therefore difficult to do PAT compounding here. But what you've seen is profitability has gone up from a loss making of nearly a 60 crore loss to around a 70 crore profit in FY25 I'm talking about. FY26, there's a 25% revenue growth, 39% EBITDA growth, and a negative 16% PAT growth, but that's because of a one-off exceptional item that came in FY25, and due to which that number is impacted. But at this point, they've done 48 crore in 9-month FY26 in terms of profit. Now, if I look at the margin trajectory as well, it's been fairly consistent, and therefore no concerns with regard to margins. What we've seen is margins in the band of 26 to 36% with a larger tilt over the last few years of it being on the higher end. So the last 3 quarters, the margins have been 38, 36 and 36%, 36.5%. So broadly, that's the tilt with regard to margins. There you go. That's the margin picture, very, very clearly visible to you. And that kind of gives you the picture that the margins are getting better as operational efficiency is starting to play out and occupancy trends are going up. You look at the balance sheet, the book value is around 500 crore, excuse me for that. And you've got borrowing excluding lease liabilities, because lease liabilities are largely excluded. But for a business like this, ideally, we'll try and understand that mismatch piece, which I spoke about. But lease liabilities at this point, we've excluded from this borrowing number, so nearly net zero in terms of borrowing, given that they have a cash balance of around 76 crore at the end of H1 FY26. Now let's look at the cash flow, and very healthy in terms of cash flow trends. The EBITDA converts very easily to operating cash flow, as you can see on your screen. It's nearly 90 to 115 odd % over the last 3 years, so no concerns there. It's the net cash flow which is possibly under pressure, but that's because of the investing that they are doing. The capex that they are doing, they're putting the free cash flow to work with the capex they're doing. And that's how it's playing out. Excuse me for that. In terms of the return ratios, you look at the return ratios. Of course, they were muted at the start. given the fact that it was loss-making, but we've seen a nice uptake. We've given this one as one of the only ones where there is a neutral. But the fact that we are starting to see an uptick, we'll try and understand how profitability goes, and this may well continue to inch upwards, given the fact that efficiency and scale is playing out. The only other piece where there could be a concern is with regard to the shareholding. The promoter holding is extremely low. 17% is the promoter holding currently. FIs and DIs do have participated in this in large measure, so you're seeing quite a lot of holding there. But that also leaves them to risk of exits coming through. And the public holds just about 16% at this point. You're looking at the analyst view, 8 buy calls, 1 hold call, and the upside. Well, I have not seen this kind of an upside yet in any of our AAYC shows. 101% is the upside. And yes, there are some smaller brokerages also there, but there's a Nuvama Wealth, there's an Ambit, there's an IFL Institutional. All of them hold this view of a very strong buy call, with 101% being the upside from here. So that's the other piece that really stood out for me. In terms of valuations, I did speak about it right at the start, 18 times 1 year forward. The 5-year average is 32, rather the 2-year average technically, because it's listed only for 2 years. That needs a correction, but 32 times, and the 2-year range is between 18 and 41 times 1 year forward. Let me go across. We have Amit Ramani joining us, Chairman Managing Director at Awfis Space Solutions. Amit, great having you. Let me try and first get your take with regard to the seat count. The seat count addition guidance was 40,000. You've trimmed it to 30 to 32. Is it going to be 30? Is it going to be lower than 30? Is there a risk that it is less than 30 at all? And point number 2, why have you trimmed that guidance?
Well, clearly, if you look at it, we've added about 8,000 seats this quarter, 24,000 for the 9-month period. For the trailing 12 months, it's almost 34,000. So the seat in terms of addition, I don't see any challenges with reaching the 32,000 mark. Clearly, if you look at the centers which are under fit out, operational plus LOI signed, we have visibility of 1,77,000 seats, or essentially about 274 centers that we have full visibility on. So I don't see that as a challenge at all. In terms of your question on why we reduced the number of seats, well, clearly, I think for us, we were in the last couple of quarters, commercial real estate has been at an all-time high. And we were very, very selective in terms of the seat additions that we were doing. Also, 100% of the seats that have been added for this year are in grade A and A plus assets, right? So the quality of the infrastructure that we're going after has improved as well. And to those ends, I think the seat addition has a bit lower. But as I said, we have full visibility for another almost 25,000 seats from here. So I don't see any challenges with the seat addition.
Got it. Okay. And what's the guidance for FY27, Amit? If you can give us a perspective on that.
So that we will give in the final quarter results for the full year, and then we will essentially share that. Currently, we are still in the process of evaluating how many seats we would add for FY27.
But would it broadly be 20%? Is that something that you would aspire for? I'm not saying you give me a formal guidance, but is that what the aspiration is for the next maybe 2 to 3 years? Would a 20% number be reasonable to expect?
So clearly, I think growth is something that the company has demonstrated over the last few years, right? As you were sharing 60% almost over the last 4 years. Obviously, as the scale increases, the growth would be a little lower, but we will certainly try to grow at a substantial clip going forward without giving any specific numbers.
Okay, all right. I did my bit, Amit. Okay, with regard to occupancy, talk to us. Of course, you've given very clear guidance in your con calls that 9-month plus, the aspiration is to get to 80% occupancy. You're nearly there as well, is what you've hinted at, 9 to 12-month band. What about below the 9 months? Because a significant part of the portfolio has been added over the last 9 months as well. So what happens below 9 months? Give us a perspective, 3 months, 6 months, broadly on a blended basis.
So see, essentially, there are 2 kinds of models we have. We have the co-working, where primarily the managed aggregation model is the underlying, kind of the model. And in that, there are a lot of, this is built speculatively. and typically takes anywhere between 6 to 12 months to reach about a 80 to 85% occupancy. Various centers are at various stages of that journey, and hence when you look at it blended, we are at about 75%. For the 12-month or more, we are sitting at 84%. So all of the centers that we have added in the co-working kind of space follow that journey. Second are the managed office centers, which could start with almost 100% occupancy day one. So in the co-working business, our overall blended occupancy ranges between 70 to 75% roughly. And in the managed office, it is 90 plus percent. So when you blend the two models, it comes to 75% for the overall portfolio. Now, all the journey of the 9 months, we are moving in the right direction for all of our centers. So we don't see any concerns of reaching, 85% plus occupancy for centers which are mature, which is 12 months or more.
And Amit, that is one of the reasons you gave as to why you don't want to really put out new seats. You want to optimize the existing ones, right? How quickly do you expect that to happen? I'm just trying to get an understanding. And this 8,000 delta, do you believe that a large part of it will be part of the addition that you make in FY27? So is it just delayed or is it permanently pushed? I'm trying to understand that.
Sure. So as I said, currently we had.
Okay, I believe we have him on a patchy line, but we will have Amit right back for us. In terms of course, the guidance, he didn't give us the guidance in terms of new seat addition. Okay, Amit, please go ahead.
No, so I was saying that the visibility for another 25,000 seats is already there with us, right? So I don't see any challenge in terms of the current guidance. And as you said, the pending 8,000, well, I have already visibility of another 24,000 on top. So I don't see any challenges with that.
Amit, is there a risk of a mismatch? Because you obviously take 30 to 35% of your seats under the straight lease model. Is there a mismatch with regard to a possibility of a mismatch if at all some customers were to suddenly drop off? What's the risk of that? And how long are customers locked in for versus how long are you locked in for? I'm trying to understand that mismatch.
So typically our lock-ins for our standard centers would be 5 years with an extension of another 5 years. So the locked-in tenure for us is typically 5 years. Our current cohort overall, the portfolio, we have a locked-in tenure of 36 months and a tenure of 36 months and a locked-in tenure of 24 months. But if you look at the cohort of 100 seats plus, we are currently sitting at almost 44 months of tenure and about 38 months of locked-in tenure. So I think the mismatch is fairly reasonable. I think even if you were to look at REITs, this would mimic that kind of lock-ins. So we have and this is across 3,400 client companies, with somebody taking one seat to somebody taking, let's say, 1,000 seats. So clearly, I think the tenure is very, very healthy for considering that flexibility is at the core of our business.
Point taken. Office Transform, there's been a bit of a pushback with regard to what you were expected to execute. First, Amit, talk to us about how the business model works. So you transform an office space, you make it much better, and thereafter a one-time fee is paid to you. Please correct me if I'm wrong in terms of the business model. Is this just delayed or is it, again, is it pushed, is maybe over the next 6 months what you were to execute, now will you execute last 6 months plus next 6 months in the next 6 months, or does it get delayed permanently? I'm trying to understand that again.
Yeah, so I think as we spoke on our earnings call, that because of some of the conditions in Delhi with the pollution controls and also some of the delays by clients because of accessibility to the buildings, etc., this got delayed, and a large portion of our portfolio for Office Transform was in North, right? As we also mentioned in our call, that currently in terms of the final stages of closure, we have almost about 8 lakh square feet of clarity, right? Of which the third party Office Transform business makes up around almost 50-60% of that. So we have visibility of almost 170 crores of business that was on the final stages of closure. Having said that, in addition, the managed aggregation, as I mentioned earlier, we did 8,000 less seats. So that means we did broadly about 6,000 less managed aggregation seats. And hence, if you look at that, about 30 to 40 crores of delta is coming from there as well. But the guidance for the full year continues to remain strong at about 20% for the office transform business. And obviously, for the next year, we have a very, very healthy pipeline for quarter 1 as well. As I said, on closure, we have close to about 170 crores worth of business, of which a large portion has already gotten closed since the earnings call. So we feel very confident that this business, at least the third party transform business that we have grown over the last year, will continue to grow.
Amit, you'll add 32,000 seats this year, which translates to a rough growth of 25% on number of seats. You've said that the better value, or rather the slightly premium segment is what you're targeting. Does this also mean better margins? And does it mean that your revenue gets a lift which is disproportionate to the number of seats you're adding? So therefore, will your revenue grow at maybe 30% on the seats that you've added, only on the incremental seats?
So currently, if you look at our occupancy, we have 152,000 seats that are operational, and at 75%, that's roughly about 115,000, 18,000, somewhere in that range. So we still have a large portion available for us to demonstrate a growth for next year. I would not want to comment on specific percentage growth, but I think what you are asking me is that, is there enough seat capacity for the growth to continue? The answer is yes. As I said, we have 152 operational. We have another 25,000 visibility there. So I don't see the growth being seat addition being any impediment to growth at all.
No, Amit, in fact, I'm asking you that all the seats that you're adding, is it in the more premium segment, and therefore, would it contribute a better top line per seat, or would it add a better top line to your company rather than just the number of seats added, or will it be proportionate to the number of seats added? And will it be better margins as well? I'm just trying to understand that piece.
Yeah. So the seat addition will continue in the proportion of roughly that 65-35 ratio that we have maintained over the last few years. In terms of the margin improvement, clearly our focus has been on premiumization for the last 18 months. As we mentioned, we have close to about 32 centers, which are as gold and elite, which is, of the 250 odd centers that are operational today. So almost 11-12% of our portfolio. Our GCC addition has been fairly substantial. Today, 20% or 1% of our revenue comes from GCCs, almost 80 plus GCCs. We currently have another pipeline of about 11 to 12 that are on final stages of closure. All of this will ultimately lead to improvement. But as you can imagine that when you have a large base, any kind of improvement takes a while. But clearly, we are headed in that direction. I would want to comment on exactly when that will start demonstrating. Some of that leverage, operating leverage, as well as the margin improvement is already starting to show in FY26, and I think will continue to be better in FY27 as well.
Okay, thank you so much for that, Amit. That's a great perspective. And viewers, that's all the time we have on AAYC today. Thank you so much for joining us.